is Avant Natural Resources. They're a privately funded oil and gas company focused on providing investors with an outstanding opportunity that delivers exceptional cash flow and value. As I mentioned, Jacob Nagy is the founder and co-CEO, and he brings more than a decade of experience to the oil and gas investment management and transaction advisory. Most recently, Jacob serves as a partner and managing director at Peachtree Partners, which was a boutique energy investment bank. To hear more of the Avant Natural Resources story, I'm going to hand it over to Jacob. Thank you, sir.
Thanks, and appreciate everybody dialing in on this Wednesday, and look forward to chatting with you guys and describing a little bit more about our company. Hopefully everybody can see my screen. If not, somebody from Intercom can chime in. But just to give you a little bit of background on who we are, we're a private company, fully privately funded. We're headquartered out of Denver, and our strategy out of the gates was really to provide direct invest opportunities for high net worth individuals, family offices, multifamily offices in the energy space. We started back in 2019 as just two of us, and we have over a dozen employees, kind of both full-time and part-time, and continue to grow. In fact, we've been one of the few guys that continues to hire through this down cycle. But we'll go over it in a little bit, but we're built very much like a traditional E&P company with all disciplines covered, and we're really proud of the team that we've been able to assemble over the last year and a half as a startup. But again, we're 100% privately funded at the moment, and really what we've been focusing on over the last several years is building momentum on both the deal sourcing side, primarily in the mineral and royalty space, and we'll walk through our portfolio here in a minute. But also on the capital raising side, we've covered a lot of ground in our first 12 months of existence in terms of meeting a variety of investors from all over the country. In fact, some even not outside of this country. That's been halted a little bit due to the COVID pandemic, but I think we're still going strong and continue to pool and bring in money through this cycle. In terms of our team, so again, Jacob Nagy, founder and co-CEO of Avant. Skylar Gary is also the founder and co-CEO, and so he and I partnered up in the beginning of 2019 and formed the company and formulated the strategy. We've since then hired a very talented, young and hungry executive team. John Harper, VP of Geosciences, Shane Kelly, VP of Engineering with a reservoir engineering background and also a strong business background. Pete Williams, who I worked with for 8 years, is just a very talented individual to have on our staff, and we're really proud of the team that we've created here. And again, we purposefully built our platform to have team members from all disciplines, and we felt like that was mission critical and also a big differentiator versus other companies our size. We have dedicated accounting staff and a really deep bench of land personnel, which is super critical for our minerals and royalty strategies. Very land intensive, and we feel really proud of the team that we built out around that asset class. So in terms of what we've been up to, we as a private company, and especially around Denver, we get this question a lot. But we've been pretty active and have put together several different vehicles to pursue oil and gas investments, primarily on the royalty side. In the mineral space. We've raised, we're getting close to about 100 million of total private capital raised in the last 12 to 16 months, I guess, since we've been in existence. We raised the first fund targeting Midland Basin minerals and royalties. We really picked a targeted area in Martin County, and we'll kind of show you that here on a map in a second. And had a thesis around the development timing and what we thought XTO might be doing, and also Endeavor in terms of how they were pursuing their asset development schedule. And that investment is in that fund is doing really well. I mean, we're very yield driven. You can see on the bottom of each of our existing funds, yield is a big component of our story. We hit 10% in our first year on Fund 1. Fund 2 hasn't been around for a full year yet, but we're coming up on that 1-year anniversary, and we should be easily able to hit that target. And then more recently, we raised a sidecar to Fund 2, and our main strategy around that was kind of in the heart of the pandemic. I think kind of April, May timeline, where you really started to see some challenges in the sector, not just because oil prices went negative, but just some of the distress from the operators, just personally, some of the landowners that we were dealing with just needed liquidity. And so we started to see some repricing of mineral assets, and we thought, hey, why don't we expand our second fund by opening a sidecar vehicle and bring in a lot of dry powder to go put to work over the next 12 to 18 months to try to further consolidate our position. So here's what we've been up to over the last 12 to 18 months in terms of what we've been able to cobble together in the Midland Basin. We're really proud of the position that we've put together. We've done a variety of deals, I think ranging as small as maybe 70,000 to up to about 25 million. So it's kind of a wide range of deal flow sizes, and everything in between. But you can see we really, our approach was really to pick an area that we loved the geology, loved the rock, loved the operators, felt like it lacked, the meaningful parent-child issues like you've seen plague some other parts of the basin. And then our main plan of attack was, let's get kind of a small interest across a big area. That way, when rigs are moving around, we always get some activity. Also, it really makes it so that no pad or well will either make our fund or break our fund. That was really important. We're kind of playing the law of averages, and so far that's really worked out nicely. And we have steady growth quarter over quarter, steady activity levels. Although this cycle certainly kind of rocked them a little bit, but still growing up into the right, which is great for our investors. In terms of the asset itself, we have an interest in over 300 horizontal wells. We have about 260 DUCs and wells that have been recently fracked. So pretty steep backlog of wells that should really drive cash flow growth in the near term. 80 new permits, so and 6 active rigs. So even despite of the downturn, we should still see some meaningful activity through the balance of this year and going into next. You can see some other stats on the bottom. We have a nice production base and nice strong cash flow base even at these prices, and in spite of some of the shut-ins that we've experienced over the course of this cycle. But overall, I think with this existing footprint, our goal is just to further consolidate. Put money to work in some sections that we believe in and really like the operator, and also fill in some of the gaps here. So I think from our standpoint and things that we've seen in the space, not a lot of folks have taken this targeted of approach and try to put together something that, frankly, operators on the working interest side try to do. Come up with something blocky and easy story to digest when you ultimately go look for a monetization event. So today I want to talk about a couple of things, but primarily focus on the impact that this cycle has had to our strategy, and we'll kind of go over a variety of things in varying levels of detail. But first and foremost, the pricing model obviously has shifted. Commodity prices have changed. Development timing has certainly been impaired, just given the massive rig count reduction. But I think less obvious, but starting to hit more press releases and research articles is how are these assets going to be developed going forward, given lack of access to capital, and also just what we know about parent-child issues. And that's something we are extremely laser focused on as we price in future acquisitions and look to put our investors' capital to work. Competition has certainly increased on the mineral space, and the main reason is you just have the same amount of money chasing fewer acres. In every basin, the core has shrunk. The Permian is no exception, and the Midland is certainly no exception. Really, if you were to overlay kind of where the active rigs are in the Midland Basin, they've all coalesced around our position, which is great for us. That's why we still have a pretty healthy market share of rig count in the Permian. The challenge is it makes it a lot harder to buy additional assets just because everyone's focused on the area now. Also it's other folks who have been playing the mineral and royalty game and other non-core basins, Rockies, what have you. I think a lot of those folks have pressed pause in their buying strategies and are refocusing on the Permian because the nature of this strategy is really trying to get cash flow and convert undeveloped acreage into cash flow, and it's hard to do that when you don't have rigs running. I think the more interesting angle for us as we continue to aggregate is just the buyer or the seller universe. We have a pretty aggressive ground game. We have guys in the field and going door to door and sending out mailers and so forth, trying to drum up deal flow, and that's pretty common amongst most mineral aggregators. But I think what's emerged in this cycle are some of the smaller folks and some of the brokers who try to flip deals or who aggregate in the short term and try to push it to kind of end buyers or folks who hold it in longer term. Those guys, were left holding the bag with this downturn, just thinking things were continuing to go up and to the right, and they certainly didn't this spring. So that's created, I wouldn't call it fire sale opportunities, but some pressure on some folks to move assets in the market when they otherwise wouldn't want to, and that's created opportunity for us to look at those type of packages. You also have some private equity backed entities who just got a little too aggressive, I think. Again, just looking to put money to work, trying to generate outsized returns, and thinking again things were continue to go up and to the right. And I think some of those folks who need to generate liquidity, whether they have leverage issues or just looking to shore up cash flow to reinvest in the current environment, it's created more opportunity for us to put capital to work. So while the competition has increased, I think the deal flow sources have changed enough for us to still feel very confident about putting smart money to work. So we're going to talk a little bit about some of the ways that we look at mineral valuations. We take a lot of variables into account, as I'm sure a lot of folks do. But just to give you a sense of the things that really move the needle, we've listed a few out here. One being rock quality. Obviously, you want to be in the best rock you possibly can. The best. You also want to look at prospective targets. The more the better. Just gives you more locations per acre. Wells per bench. Again, you want as many locations as possible that are economic at these prices that encourage operators to develop them prudently. Type curve EUR, obviously really important to see what production levels come out of the ground. And then timing, that's the biggest challenge as in the mineral strategy. We don't have an affiliation with an operator, and so for us it's a lot of a guessing game and really an educated guessing game, and we feel like we have some pretty interesting ways to attack that challenge. But rock quality and targets are easy to identify, just especially for our team with a deep bench of technical staff. We feel like we can get to some very high quality areas, as we've shown in our existing portfolio. Wells per bench you start to get into some variables that vary significantly by operator, even within the same rock. And so that is a little bit out of our control as a mineral owner. We try to align ourselves with the operators that we think are going to drill the most wells per section, but that isn't always the case. And as a result, type curves can vary. Again, you often see stronger well performance correlate with rock quality, but it really also interplays with wells per bench and density. And then, as I mentioned, the last thing, the development timing. How quickly does your undeveloped acreage convert into cash flow? Very challenging, unless it's something that's is fully ducked up. It's challenging to predict. We feel like we have a few tools that are at our disposal to make a more educated guess than others, and that's proved somewhat accurate with our first couple funds, but it's a big challenge. And as a result, you can see in the bottom the wide range of valuation disparities. So you can, if you're at the low end of all those variables, the asset might only be worth 3,000 per net royalty acre. If you're at the top end of all those variables, it could be worth 30,000 plus, and that's a very wide range. And so we try to make our best assessments to get to a value that we think makes sense for investors. So this is to take it. This slide on 7 is just to take it a little step further and talk about operators and operator premiums. And what we found, especially as my background being on the banking side and working with primarily operators and a lot of public company operators and the public investor universe, it's a totally different calculus between what makes a good operator in the public investor world versus what makes a good operator as a mineral owner. And so what we've done here is just outlined 4 just illustrative companies and some of their varying development styles, results, and their inventory life. And those are very important variables as you think about how you should value future acquisitions. And so at the top, an example major operator trading at a strong multiple, drilling a lot of wells per section, not getting necessarily the best results, but maximum NPV, and shorter inventory life, just given high levels of activity, results in 14,000 per net royalty acre. On the flip side, you go down one row, the mid-cap public company trading still a strong multiple, not quite as strong as the major, not drilling as many wells per section, getting better results per well, but with an incredibly long inventory life. It's really hard to justify, accelerated pace of development. And as a result, the valuations go down because you have to take the time element into account when you model this out. Likewise, as you step down to the small cap public operator, not trading at a very strong multiple, but still developing the asset in a very prudent way, much shorter inventory life, just given smaller scale, smaller asset. And with some of those guys who are developing the asset the right way, you can get to you can lean in on valuation just because they're often in good rock, developing it the right way, and just don't have a ton of inventory. So you have a high degree of confidence they'll get around to it within short order. And then the private guys are a little bit more of a hodgepodge of development styles and strategies and motivations to bring value forward. So that gets a little trickier. And so we often tend to stick with some of the larger guys because we tend to find that they think a lot more like the larger operators, larger public operators in the basin. But again, I think the big disparity here, the big thing we identified early on was just because a company might be well regarded in the public space, for all the reasons that I'm sure you've heard throughout this conference in terms of generating strong cash flow from every well that they drill, might not be the best outcome for the mineral owner, as just because you want to be able to extract maximum value each time a rig lands on your section. So again, how do we as Avant think about safeguarding our investor returns? First and foremost, we try to put ourselves in the shoes of the operators. We're fortunate to have a very strong team that's drilled, just about 400 horizontal Permian wells. That really helps us think through, development patterns, and that we can take in data and try to make assessments of what we think is going to happen in the future. And also, we need to think like an operator with the limited access to capital. It's no longer growth at all costs. It's kind of live within your means. And how is that going to impact development strategies for operators across the spectrum, all the way, from majors all the way down to the small privates. Honor the data. It's nice to think that every well is going to continue to get better, but that certainly isn't the case. And so we look at every single well. We try to get as educated as we can in terms of where it landed, what the completion technique looked like, and factor that into our database and our analytical work, which is very detailed. It's, you know, unique type curves by area, by operator, by bench, and varies based on how many wells they permit and plan to drill within each section. So it's a very detailed database that's taken a long time to put together. But it's an extremely valuable tool as we assess future opportunities. Predictive analytics, it's very, it's certainly an art as much as it is a science. But studying what people have been doing, especially in terms of density tests, and how those results look, and trying to think through how those results are relative to what's going on in the future, I think is really critical. We have some proprietary tools to think through rig activity, mainly thinking about operators' acreage positions and how they might move throughout those acreage positions. Again, it kind of goes back to the thinking like an operator strategy. And that's been very helpful as we look at future acquisition opportunities of undeveloped acreage. I think the most important thing right now for us is just to stay disciplined. It's pretty easy to price in best case scenarios, like I showed on the previous 2 slides previous, and get really excited about the future value of some of these assets. But the reality of our business is, nothing ever goes as planned, so you have to risk adjust things accordingly. And so we often see some of our competition certainly price in some best case scenarios, and you can see when you do that, it's pretty easy to acquire assets. But I think that's a challenging model given the state of affairs of our industry. But also, more importantly, minerals are highly fragmented. Every time we think deal flow slowing down, it really ramps back up again. The next deal is always seems to be around the corner, and we screen a ton of deals every week, almost every day. And I think being patient will pay off, especially in this time of extreme, not only volatility but uncertainty. I think where we see our peers and friends in the space foot faulting, if you will, is one, just pretending to know the market when no one really knows the market right now, just given the uncertainty of our space over the next even over the near term. I think there's this common belief, especially among the landowners, that mineral values only go up. And what we know now, after all the density tests and parent-child issues, that there can be some challenging assets, even if the rock is in the core. And which leads to the last thing, which is the variation from section to section, especially in the Permian. I'm sure it's the same everywhere else. Is real and vast, and to think that every section is the same is just going to cause a lot of mistakes along the way. So we look at every deal on its own. It has to stand on its own, and we have to diligence it on its own. In terms of what this all means for us and our strategy, it's resulted in is just an rig concentration across the major basins and how that compares to our footprint in Martin County. And you can see that we have over 4 times the average of the broader Midland Basin. We purposefully and by design picked an area we thought the rigs were going to retreat to if things got challenging, and that certainly is evidenced here by this chart. And that's the nature of this game. It's in what we pitch to our investors is, hey, we feel like we can do a good job acquiring undeveloped acreage and have a strategy to predict that it's going to turn into cash flow in the near term. And so far, that's working out for us. And then lastly, where do we go from here? We think this is a very strong asset class to play a potential rebound in the sector. Obviously, not having any CapEx and OpEx exposure, but also exposure to just core rock and core inventory helps. But also it's a yield vehicle that returns capital to investors. I think that's, a big part of what you're seeing today in the public space on the operator side. Just a lot of variable dividend models and distribution stories being pitched to investors to try to regain confidence. And that's been just a core fundamental of the mineral and royalty space since the beginning. Increased scale in the public markets is mission critical. It's hard for widespread institutional investor excitement to occur, just given the limited public float and just not very many companies. Also, the public companies seem pretty afraid and hesitant to use their stock, and I totally get that. Everyone's kind of been beaten down over the last several months, but I think everyone, ourselves included, if we're in discussions with somebody of that nature, you just have to be honest about your relative value. We had a lot of those conversations back in the banking days when looking at stock for stock mergers, and assuming you're using similar parameters between the two counterparties, there's probably a win-win scenario there, just as there is on the public operator space. I think for us as a company, we're going to continue to be a capital raising and deal sourcing machine. Where I think we joke internally between Skylar and I that we'll never stop fundraising. It seems like we're always on the hunt to continue to grow and put money to work where we think it makes sense. And also we're just expanding our network and getting our teeth more thoroughly into the deal sourcing side of things. I mean, feel like we see a lot of deals, and just want to continue that to grow. Want to see that grow and look at other different asset classes as well. And then I think lastly, just staying disciplined. I mentioned that before, but that's kind of the core of our business. And we're a small company in the grand scheme of things, especially relative to a lot of the folks that are presenting in this conference. But I think with that, it allows us to really high grade opportunities and focus on some high return acquisitions and investment themes. And then lastly, I think just again to reiterate, our team is very unique, especially for our size, and just the speed in which we can evaluate a variety of things just is really going to help us look at make sure we have a strong pulse on where the market's going, but also it's a very talented group that will further the disciplined approach to how we look at the market. So with that, I mean, thanks for everybody for dialing in, and if there are any questions, happy to address them.
Jacob, great presentation. Thank you very much. Very informative, certainly on the mineral and royalty side. A couple quick questions for you while we have just a few minutes of time. Why did you choose the Permian as a focus for your mineral strategy?
Sure. That one it was pretty straightforward when we started the company. I think first and foremost, while I was at Petrie, I spent a lot of time in Midland and was down there meeting with clients very regularly, so very familiar with the market and the players. And I think second, from a mineral strategy standpoint, it's really hard to go to spots where the rigs aren't active. And so when we looked at which part of the lower 48 resource play pool was furthest up the curve in terms of manufacturing mode, while also having the largest rig count in the Midland Basin and the Permian stood out.
Okay. Next question. How have you been able to compete with there's a whole slew of other mineral and royalty companies out there. How have you been able to compete, kind of being somewhat of a new entrant into the space?
Yeah, that's something that continues to evolve. I think first and foremost, building out the team and the infrastructure was critical. I think when Skylar and I first started, and it was just the two of us, it was tricky to wear a lot of hats and still be effective and fast. I mean, what boggles my mind in this space after coming from the banking side was just how quickly the deal flow moves. Some of the turnaround times are 24 hours, so you have to have the infrastructure and team in place to look at things. And I think that's where we have an edge, and part of that's our focus area. We're very focused, as everybody can see with our map, on a certain part of the Midland Basin, and that one allows us to screen away opportunities that don't fit our mandate, but also gives us a differentiated insight and awareness of what's going on there, so we can react quickly. So I think speed is a big thing. Having a full technical team is a very, very big thing. And then just our network. We have some great folks on the ground who are doing, drumming up a lot of proprietary deals for us, which has been very helpful. And then we have a good network of contacts in the industry to also help us with deal flow. So I think speed, the speed in which we can get stuff done, our network, and then also our capital. Our capital, we spend a lot of time up front talking about our thesis and buy strategy and parameters and what we're going to target. That way, when investors come in, we basically have the reins to go put that money to work and don't have to constantly be checking up the food chain for every single deal. So that kind of helps with the speed as well.
That's great. And you mentioned your team. You've been building that for a couple of years, going from you and Skylar to what size is the team now, and how much credit does that team get for helping you build this company? It sounds like it's great help.
Yeah, we're getting close to about a dozen full-time guys, and we have a number of part-time or contract work folks. With some of the team that we've built, we took an interesting approach by trying to capture talent where we saw it early on, whether it's on the land side, accounting side, or technical side. And to the extent we couldn't bring them in full time yet, just didn't have enough work or what have you, we've been able to structure some pretty creative part-time arrangements. So, all that being said, it's been fun to grow the team, and we're really proud of what we've been able to build so far, and look forward to continuing to grow it.
And a couple questions coming in. Where do you see oil prices going in the next 12 months?
Yes, it's a question my former colleague Tom Petrie used to always get, and he's very eloquent at responding. But I think you continue to see some fall off in U.S. production, and you're just not seeing the activity levels to support further growth, which would lead you to indicate that there might be a supply shortage, which could bump prices a little higher. The macro uncertainty has me a little worried. So, I mean, we certainly aren't underwriting to prices much higher than where they are today. And our goal in the mineral strategy in general, it's not, it's trying to protect your principal and principal investment and make a modest return. So we're not trying to bet on higher prices, and we're definitely trying to protect against prices going lower.
Well, while you got the crystal ball out, I'll ask you this question. What do you think the outcome of the election, if the administration stays the same versus if there's a change for your business?
Yeah, I mean, being in Denver, it's pretty easy to get caught up in what the election can or cannot do. And, we certainly saw that in the DJ Basin when some of the setback initiatives were introduced and some of the challenges that the industry faced during that time. We, as a small company and focused in Texas, we're trying to not get too caught up in what's going on. It seems like it's certainly topical, but I think at the end of the day, if I think the biggest risk from our future growth strategy is where it might prevent us from going today. I think it's hard, and it's hard for us and hard for our investors to take binary risk outcomes where putting money to work on federal acreage, if that can be kind of pulled out from under them. So I think where we look at putting additional capital to work, it'll be on areas we think will be somewhat insulated from the outcome in November, but we'll just have to wait and see. I think obviously if something of that nature were to occur in terms of the federal acreage challenges to develop those lands further, that certainly would have some knock-on benefits to us potentially.
Jacob, I got to say thank you for your time today. Great presentation. I'm sure your agility and speed of your team in terms of looking at deals and getting them funded is going to help you out going forward. So good luck going forward. Thank you for participating in the 25th anniversary of the Oil and Gas Conference, and you have a great day.
Thank you. Thanks for having me.